going up. So there are kind of winners and losers in the consumer sector. What do you see in terms of the kind of the health of the consumer and categories are benefiting or giving ground?
Yeah, I mean, if you look at PCE, which is the best comprehensive measure of what's going on for the household sector, what you see is that, and the overall personal income and spending report, you see that incomes are rising at 4-ish% a year on a year-over-year basis, on a nominal basis, and spending's rising about 5% a year, which means that the savings rate is very slowly declining. And the vast majority of spending growth is mostly out of the income growth that households are experiencing. And so that is, that's pretty sustainable. Like if you're a household and you have a mortgage locked in, at 3%, and you've like paid off your cars, and you're basically just expanding your spending based upon your income, that can continue for a long time. And it's not like you have the sort of buildup, the unsustainable buildup of debt that we saw, in the GFC, the pre-GFC expansion period.
Yeah, I agree. I mean, balance sheets are cleaner and healthier. You've got record net worth, whether you're looking at liquid assets like the stock market or even housing prices. What do you make about all these headlines around, hey, look, there's delinquencies are going up and the consumer's overextended on credit card debt? Is that a head fake, or how do you interpret
Well,
that?
I think, credit card, first of all, like credit card debt is teeny tiny in the economy in terms of the overall. In terms of
or what's the maybe a trillion now, right?
A trillion, yeah. But I mean, it's growing. But remember, that's in level terms. The vast majority of it is revolving in dollar terms, meaning like, I mean, everyone has a credit card and does the predominance of their spending on a credit card, right? And so there's a lot of revolving credit that just gets paid off every month. On dollar terms, it's something like 80% of that borrowing gets paid off in full every month. And so when you look at it relative to something like spending, nominal spending, or disposable income, it's basically at the same level it was. It's been for the last 25 years, basically. So it's not a big driver of what's going on. I think the increase in delinquencies and stuff like that in credit cards, there was a push down market by many of these credit card companies in the post-COVID period, kind of to capture the stimulus checks to lower credit-worthy borrowers. And, they're being charged a lot and they're defaulting a little. And, it's not that surprising, but that's like pretty marginal. I mean, we're talking about like, tenths of GDP kind of ranges of impact here.
It's kind of amazing how like $1 trillion in credit card debt actually isn't a big number.
It's just not. Exactly.
I mean, the mortgage market is like 8 to 10 times the size of that. The student loan debt market is larger than that. The corporate debt market's an order of magnitude times 4 larger than that. So, right. But it makes for scary headlines when people see that. And
yeah. And what are we seeing? We're seeing charge-off rates in credit cards at, 4.5%. But a lot of that has been, and that's, I mean, in the 2008 crisis, right now it's at 4.5%. In the 2008 crisis, it was running at, 10, 11, 12. It never gets really much below 3. So, it's picked up a little bit because of some strategic decisions on the part of credit card issuers. But we're certainly not talking about anything that's meaningful. And certainly in the context, remember, the way banks think about this is not what their net charge-off number is. It's what their net income is, right? Their NIM on these loans are relative to the charge-offs. And so if they're charging 30% and charging off, 4.5%, they're on net making money on these deals.